Hi, welcome to Market Minute. I'm Patrick Adams. You can get a hard copy of our Market Minute report on my website at Patrick Adams CFA. The big news this week is going to be the Federal Reserve meeting on Wednesday, where they're going to increase interest rates by 25 basis points and probably indicate that they'll increase rates again 2 more times by 25 basis points and leave the Fed fund rate at that level for an extended period of time. This is nothing new. The market doesn't believe it. Likely will put us into a recession and push the stock market down some from here. But it's nothing new, and it's just the reality for the stock market has to get comfortable with this. Last week was a huge week for earnings reports. This week's even going to be bigger. What happened last week was a lot of the economically sensitive stocks reported. The earnings estimates for the S&P dropped from 229 to about 226, so down about $3. So where did it come from? I'll point out 4 different reports for you to give you kind of an indication of what's happening in these somewhat cyclical or very cyclical companies. 3M is basically in everything. It was so bad. I can't tell you how bad 3M was, but they indicated on their call that smartphones, so obviously smartphones is a big product, will be down 10% in the first quarter, tablets down 15%, and TVs down 30%. We expect TVs to be so weak because of the trends in housing, but think about that, how weak these technology or electronic devices are. Dow Chemical, also very bad report, down 8% in the fourth quarter in volumes, and related to destocking. It accelerated in December. Expect a very similar trend in the first quarter. That could be the bottom for Dow and some of these other cyclical companies, but it's so dismal. The stock market hasn't discounted this yet either. Intel was probably the worst earnings report I've ever seen in my life, and it'll be again really bad in the first quarter. Again, destocking by their customers, way too much inventory. And Texas Instruments, another semiconductor company. This gives you an idea, a growth company, but their inventories are 157 days, up 24 days sequentially from the last quarter. I just can't imagine where they're putting all this stuff. So in general, the semiconductors and semiconductor capital equipment companies were very weak, indicated the first quarter is going to be weak. I would expect that, again, the first quarter to be the bottom, but the outlook's not all that great either. As you look out to next year or the rest of the year and into next year, the earnings look like they might start to turn positive in the fourth quarter and then have a recovery in 2024. That's what the market's betting on at this point. Now, areas that were good, defense was strong, aerospace strong, autos look like they're recovering. There's pent-up demand for autos as inventories are very low. And I tell you, 2 companies to watch, Raytheon and Halliburton, both had really good reports, gave really good outlooks. These are quality companies, and if these stocks would pull down, I would strongly advise to take a look at them. The technicals. Now, just keep in mind, the technicals are going to be driven by what happens on Thursday as well as Wednesday when the Fed meets. But the technicals will either get much better or they're going to get a lot worse. Apple, Google, Amazon report on Thursday. It's a large part of the S&P 500. We think what's happened this year is we had a snapback in the markets because of excessive tax loss selling that occurred in December and in the fourth quarter last year. So we're getting a technical bounce. Have the fundamentals improved? Not a lot, but it's making the technicals look a lot better than probably what they should be. The S&P 500 has now crossed the 200-day moving average. There's some resistance in front of it. I want to show you this chart here. So you can see this line is the S&P 500. It looks like it's forming a bottom. We got some higher highs. It looks like an inverted head and shoulders. Okay, The green line here is the 50-day moving average. It's getting close to the 200-day moving average. That's called the golden cross. As it crosses this, and indicates potentially a very big move in the market to occur. I kind of view this as it's a late signal personally. I'd be surprised if this occurs unless the Fed takes a very different stance on their rate increases and maybe starting to moderate. So you can see the red line here is the trend in the market. The market's broken through that, and it faces some resistance at 41.20. So technicals have improved greatly. The fundamentals have not. Fundamentals, in my opinion, look bad. Looks like we're going into a recession. Again, the cyclical companies that reported did not report good quarters. They reported horrible quarters and gave bad outlooks. You can subscribe to Market a Minute by going to my website, Patrick Adams CFA, clicking on subscribe to Market a Minute. We will send you an email every week, plus potentially the video that goes over the Market a Minute very quickly. Take care, and hopefully things turn out well this week.